A topic dominating market discussions is the People's Bank of China's PBOC decision not to cut interest rates, dashing expectations of monetary easing. Both the 1-year and 5-year loan prime rates LPR have remained unchanged at 3.1% and 3.6% respectively. This stability has persisted for nearly half a year since October 21 last year, despite ongoing policy signals hinting at potential reserve requirement ratio (RRR) and interest rate adjustments. Why has the much-anticipated rate cut not materialized? Several theories have emerged within the market. 1. The Federal Reserve factor. One primary factor is the stance of the Federal Reserve. China finds it challenging to cut rates while the Fed maintains its current position. A significant interest rate differential currently exists between the two economies. The yield on the 10-year US Treasury bond stands at 4.35%, starkly contrasting with China's 1.65%. Such a pronounced inversion risks exacerbating capital outflows, which could undermine asset price stability. Widening this gap further would only intensify these pressures. 2. Economic data optimism. Another perspective points to the relatively positive economic data released in the first quarter. This performance has reduced the immediate urgency for a rate cut. Policymakers may be adopting a wait-and-see approach, reserving this powerful policy tool for when the actual impact of tariffs becomes more evident. Additionally, given the limited scope for rate cuts, each adjustment must be carefully considered and timed strategically. 3. Prioritizing financial stability. China's economic history reveals a clear pattern. When economic and financial challenges coincide, financial stability takes precedence. Economic issues often require long-term policy solutions, but financial crises can trigger immediate and severe economic shocks. Past events, such as the 1998 banking non-performing loan crisis, the 2008 global financial meltdown, and the 2015 stock market crash, were met with swift and decisive action precisely because they threatened the financial sector's integrity. Currently, the banking sector stands at the epicenter of financial concerns. From major state-owned banks to smaller city and rural commercial banks, the entire industry faces significant challenges. Cost reduction and efficiency improvement have become top priorities for every player. Take Weihai Blue Ocean Bank as an example. It has experienced its most severe setback since its establishment, with revenue plummeting 39.42% year-on-year and net profit crashing by 47.86%. Its cost-to-income ratio has even breached regulatory limits. Meanwhile, the Industrial and Commercial Bank of China, once the world's most profitable bank, reported a 2.5% year-on-year decline in revenue, marking its third consecutive year of decline, with net profit growth at its lowest ebb since going public. The industry's net interest margin, with 1.8% serving as a critical threshold, has already fallen below this level on average. A rate cut at this juncture would further squeeze the net interest margin. Compounding the issue is the rising trend of non-performing loans, which shows no signs of reversing in the short term. In the first quarter alone, the 5 major banks witnessed a staggering increase of 50.149 billion yuan in non-performing loans, nearly double the 25.648 billion yuan recorded in the same period last year. This explains why regulatory authorities swiftly halted banks from offering consumer loans with interest rates as low as 2.5% upon their introduction. Such products posed significant financial risks. Banks rely on the difference between lending and deposit rates to sustain their operations. With an escalating bad debt ratio, maintaining a substantial gap between lending and deposit rates is crucial for financial viability. Given these circumstances, the current interest rate spreads, net interest margins, and overall economic fundamentals simply do not support an interest rate cut. As a result, any rate adjustment remains on hold, and policymakers must exercise patience and strategic restraint. As the old Chinese adage goes, blessings never come in pairs, but misfortunes never come alone. For many, the absence of a rate cut is disappointing enough. Adding to the concerns is the potential reduction in deposit interest rates. In the first quarter of this year, domestic household deposits surged by a record 9.22 trillion yuan. To lower lending rates while easing pressure on net interest margins, reducing deposit rates may become necessary. Currently, yields on domestic wealth management products have dropped to around 1%, and the projected interest rates for savings insurance products have also declined to approximately 2.5%. Why do people continue to save despite such meager returns? For the vast majority of non-government employees in China, two common concerns drive this behavior: income instability and the lack of reliable retirement support. The spectre of unemployment at 35 looms large, accompanied by low fertility rates and alarmingly low pension replacement rates, especially in rural areas, where pensions are virtually non-existent. These challenges affect generations from the 1970s to the 2000s. In such an environment, the desire to save persists regardless of deposit rates, underscoring the deep-seated sense of financial insecurity. It's important to note that a reduction in deposit rates does not guarantee a subsequent cut in lending rates. So, when will the opportune moment for RR and interest rate cuts arrive? There are two key factors to watch. First, significant changes in economic fundamentals, such as a sharp deterioration in macroeconomic data. Currently, the most significant wildcard is tariffs. If current tariff policies remain in place, their real impact is expected to surface in 1 to 2 months, around May or June. Second, the actions of the Federal Reserve, which are also closely intertwined with the effects of tariffs. Fed Chair Jerome Powell has emphasized prioritizing inflation control, making the Federal Open Market Committee meetings on May 6 and June 17 pivotal dates to monitor. Compared to interest rate cuts, reducing the reserve requirement ratio may be a more feasible short-term option. However, a major challenge remains. Commercial banks may use the released reserves to repay interest-bearing loans from the central bank. This could lead to funds circulating within the financial system without flowing into the real economy, a phenomenon known as hollowing circulation. To address this issue, since last year, the central bank has been taking proactive steps, including banning manual supplementary interest on deposits, curbing high-interest deposit solicitations, and lowering the interest rates of non-bank interbank demand deposits. These measures aim to create more room for future RRR cuts. Please be aware that economic analysis involves numerous variables and uncertainties. The above content is based on current market observations and logical deductions and should be used for reference purposes only. Recently, another piece of news has been making waves in the market: the intensifying competition between JD.com and Meituan in the food delivery sector. JD.com recently issued a rather vehement announcement, essentially taking aim at its competitor. For instance, it accused a certain platform of practicing the choose one out of two tactic, causing riders' incomes to plummet by 16% to 25%. To maintain its monopoly, the platform allegedly blocked riders, jeopardizing their livelihoods, and had failed to contribute to riders 5 social insurances and 1 housing fund for over a decade. While the platform saved money, riders were left without basic safeguards. Additionally, it was claimed that the accident rate on this platform was more than 3 times that of the express delivery industry, yet the platform turned a blind eye to this, showing no regard for the riders' safety. Moreover, 60% of the stores on this platform were reported to be unprofitable, while the platform itself could rake in substantial profits through commission fees. Phantom food delivery services were said to be prevalent on the platform, with blatant disregard for food safety. The backdrop of this announcement was that JD.com's food delivery service had recently experienced significant delays. JD.com believed that the primary cause was the obstruction by its competitor, which made it difficult for the company to recruit enough riders. Subsequently, Meituan responded to JD.com's accusatory statement. The core messages of Meituan's response were as follows. Firstly, the claim that part-time riders on other platforms were being blocked was nothing but a rumor started by an individual in Anhui. Secondly, Meituan expressed its reluctance to engage in a war of words with certain platforms. The third is that only one sentence in the opponent's manifesto is true, and that was the issue of order delays. It can be said that the food delivery market hasn't seen such intense activity since the three-party battle in the past. Some time ago, JD.com made a high-profile announcement of its entry into the food delivery industry, but the market didn't take it too seriously at first. This was because in 2023, Douyin had also made a similar move, which sent Meituan's stock price plummeting. The stock price hit a low of 61 Hong Kong dollars. Later, it gradually became apparent that Meituan's moat in the food delivery business was so deep that Douyin couldn't even come close to challenging it. Given that even Douyin, with its massive traffic and financial resources, couldn't pose a threat to Meituan, the market didn't consider JD.com's potential threat seriously either. However, JD.com's willingness and motivation to engage in the food delivery business might be much stronger than Douyin's. This seemingly aggressive move by JD.com into Meituan's core business territory is actually a counterattack after Meituan's flash purchase service has encroached on the market share of JD.com Express. Meituan's flash purchase, relying on Meituan's vast food delivery logistics network and the layout of front-end warehouses, can deliver goods to consumers within 30 to 40 minutes. This has severely impacted JD.com's business model of next-day delivery, snatching a significant number of orders from JD.com. In 2024, the order volumes of daily necessities such as alcoholic beverages, snacks, and dairy products on Meituan's flash purchase exceeded those of multiple e-commerce platforms. The order volume of 3 Celsius home appliances was close to 40% of JD.com's single quotes S. In the subcategory of computer and office supplies, the order volume had already surpassed that of JD.com, and the order volume of mobile communication products also reached 40% of JD.com's single quotes S. Although there is still a gap in the average order value, the growth rate of orders for core categories like 3C home appliances has exceeded market expectations. And the 3C home appliance category is precisely the foundation of JD.com's single quotes S business. Despite the fact that the national subsidy for home appliances in 2024 brought JD.com a substantial increase in business volume, under the impact of Meituan's flash purchase, JD.com's market share in e-commerce dropped to the 4th place. So, on the surface, it seems that JD.com is entering the food delivery market with great fanfare, but in reality, JD.com aims to consolidate its e-commerce foundation by building its own food delivery army or an instant delivery chain. This is a battle that JD.com has to fight to counter its opponent and disrupt the competition rhythm. In the intense competition between JD.com and Meituan, consumers are undoubtedly the biggest beneficiaries, followed by some merchants. According to some merchants, all the subsidies provided by JD.com's food delivery platform are borne by the platform itself, and merchants don't need to pay extra. This means that merchants can earn more compared to other food delivery platforms. Next are the food delivery riders. Although not all riders are willing to have the 5 social insurances and 1 housing fund, with the competition between the 2 platforms for riders, their incomes are likely to increase. Of course, not everyone can be a winner. In the short term, the losers are the food delivery platforms JD.com and Meituan, as well as the shareholders who have invested in their stocks. The food delivery business benefits from economies of scale. Meituan needs an average of 60 million orders per day to ensure profitability in its food delivery service. Moreover, food delivery is just a traffic entrance, and Meituan's main profits don't come from food delivery. Currently, JD.com has an average of 5 million orders per day, with an average loss of 8 yuan per order, resulting in a daily loss of 40 million yuan. If the order volume reaches 20 million per day, the daily loss could reach 100 to 200 million yuan. JD.com's single quotes S net profit in 2024 was 41.4 billion yuan. The longer the game of burning money on subsidies continues, the less money the company will have for stock buybacks and cash dividends, and there won't be significant commercial growth either. Data shows that as of 2024, the scale of online food delivery users in China had reached 545 million, accounting for about 50% of the total number of internet users. According to the data from the China Cuisine Association, the scale of China's food delivery market reached approximately 1.2 trillion yuan in 2023, accounting for 20.6% of the total catering revenue. It can be said that the food delivery market has long passed its high-growth period, and the total market size has basically reached its peak. Therefore, although most people cheer for JD.com's single quotes S entry into the food delivery market, they also harbor doubts about its success. Many believe that JD.com's food delivery service is not sustainable. Once the subsidies are removed, it will return to its original state. And perhaps one party will suffer an even greater loss, which is ele.me. With JD.com and Meituan waging a fierce price war and subsidizing merchants and consumers, if ele.me fails to keep up, its market share will be divided up by JD.com and Meituan.